Hey everybody, welcome back to Investing with Wesley. Recently in a lot of my episodes, I've talked to you about fundamental investors not wanting to get into the market because they can see that everything is overvalued. Wouldn't it be nice for you to have the exact same power that some of these other brainiacs have? Wouldn't it be nice for you to actually be able to analyze a stock or an ETF or a company yourself and determine if it's overvalued, and if so, how much, and make an informed decision on whether or not you should invest in that particular company instead of just following all the hype and the comments and the meme stocks out there? In this video, I want to teach you exactly how to do that. So let's get into it. Now, when it comes to fundamental analysis, there's 7 things I particularly look at when determining whether or not I should buy this particular company. Now, for the first half of this video, I'm going to be standing right in front of you like I normally do, explaining you what these 7 things are I look for. And then at the end of the video, I'm going to readjust the camera and focus on exactly what I do online and how I find all this information so that you know what you're doing moving forward as well. The very first thing I look at when I'm analyzing a company is to make sure that their earnings are upward trending. Meaning year after year, they're making more money than the previous year, no matter how little it is. I want to see an uptrend when it comes to their earnings. The second thing I look for or think about isn't so much numbers based. I think about if this particular company is going to be needed in the future, or if automation will eventually phase it out. And with that, I want to look at its competitors and figure out what makes this particular company stand out. If I think a company stands out but is not needed in the future, then it will definitely sway how long I plan on holding onto this company if the rest of the numbers add up to make me want to buy it. So after you've figured out what trajectory their earnings are going in, whether it's up year after year or down, you also need to figure out whether or not they'll still be needed in the future and if they're an innovative company and an adaptable company as well. The third thing I look for is their debt to equity ratio. Now specifically what I look for is a debt to equity ratio of about 0.3. And to find this ratio, you divide the company's total liabilities by its total shareholder equity. And whatever that number is your debt to equity ratio. Now 0.3 is a great baseline, but you also have to factor in that certain companies work more off of debt than others. Like construction, for an example. Pretty much all of the construction companies work off debt, and then when they sell whatever it is they've been working on, that's when they turn their profit. So keep in mind you want to have a low debt equity ratio like 0.3, but depending on whatever sector this company falls in, it may be okay to increase that debt to equity ratio just a little bit. If you're looking at a company that has a high debt to equity ratio, look at their competitors. If all of the debt to equity ratios are high and theirs is the lowest, even though it's high from my standards, it still might be worth investing in because clearly whatever industry they're in is a high debt operating industry. Now another thing that's going to take some comparison from this company's competition is their PE ratio. Now typically I look for a PE ratio that is less than 15, and this is just to make it as optimal as possible to invest in. If you're unaware, a PE ratio is the price to earnings ratio. And basically in layman's terms, the PE ratio is the price you're willing to pay for $1 worth of that company's profits. So if you see a PE ratio at 15, that means you're willing to pay $15 for a dollar worth of their profit. And that may already sound like a ripoff to you, but considering there's other companies out there that have a PE ratio of about 800, you can see why I think 15 is so fair. Now also just a bit of extra information, the average PE ratio across the entire market is 15 as well. So if I can find something that's about 15 or lower, then I know its price to earnings ratio is less than fair price and I'm coming in at a good time. If it's vastly over, then I know it's considered overvalue, and I would have to do more research to determine whether or not I want to buy in at that overvalued price or not. More often than not, it's not. But there's a select few times where I will buy in on what's considered an overvalued stock just because I believe that much in the company and it will continue to grow, making my investment worth it. In order to find the PE ratio, divide the share price by the earnings per share. Doing this will get you your PE ratio. Now the fifth thing I look at are the dividends. Does the company pay a dividend or not? If they do pay a dividend, is the amount they pay going up through over the years or going down? Basically, all I'm looking for is some cash flow return on my investment. If I buy a company that is undervalued and that I know is going to go up into the future, the one thing that would just be a cherry on top for that investment would be if they pay out a dividend. But also looking at their dividends from a fundamental aspect can determine how well a company is doing. So if year after year the dividends they're giving you go down, this means that they're trying to hold on to as much cash as possible, and they're probably in some financial trouble. On the other hand, you have companies that have dividends that they continuously go up, meaning year after year they're giving you a little bit more of the profits they generate. Really good, solid, stable value companies. But just recently, a staple for value companies is AT&T, and they decided this year they were going to cut their dividend by a large amount. Now, to most people, they would think, oh, something must have happened in the 2020 pandemic that made them lose a bunch of profit. They're not going to want to give any profit. I'm not going to make any money. There's going to be some panic in there causing people to bail out of that particular company. But if all the other aspects are good, meaning year after year prior to the pandemic, their profits were going up, their dividends were going up, and everything was going up, then they're probably not on the verge of bankruptcy. They're probably just going through a little bit of hard times right now, and they'll get back on their feet by conserving their dividends instead of paying them out to their investors. Once they do get back on their feet, it's my belief that they'll continue to pay out the dividends they used to pay, and everything will be back to normal. So, looking at how this particular company treats their dividends will give you a little bit more insight on whether or not you should invest in them. Now, the last two fundamental analysis things that I look at is the leadership of the company itself, as well as is there an uptrend in the stock price as well. So going back to leadership, what I look at is who the CEO is, who the CFO is. I get as much information as I possibly can on the chief officers of that particular company. A good example of this is when the crash hit in 2020, cruise lines and the travel industry hit hard. And even though there is a bunch of different companies out there when it comes to cruises, I chose solely to invest in Royal Caribbean over Princess Norwegian and all the others. I chose Royal Caribbean solely because the CFO's reputation with Royal Caribbean and the fact that they were able to secure a $2 billion line of credit that they could float their expenses and their debt on until the travel industry reopens and they get back on their feet. So taking Royal Caribbean's CFO's reputation, as well as paying attention to all their press releases and knowing that they secured a $2 billion line of credit, made me invest in them over every other cruise industry out there. So as I say, knowing as much as you can about a particular company's leadership can go a long way in deciding whether or not you want to invest in them. And the last one is probably the one everyone already does anyway, and that is look at the trend lines of the stock price itself. Does it continuously go up over the years, or does it stay level and not really go up or down in value? And if it does stay level, why? Is it because they pay a large dividend? Often REITs, real estate investment trusts, their share price will stay flat. They'll stay about the same price, but pay an 8, 10, even 12% dividend. So a lot of people go into REITs knowing they won't see a lot of price appreciation in their investment, but they will see a lot of dividend reward. So that is the last thing I look for in my fundamental analysis of any stock. Is there an upward trend and is there a price appreciation? Okay, now let's move this camera around so you can see exactly what it is and where I go online to determine all this information.